I gave this talk last night at the Silicon Valley Bitcoin meetup, and I didn't get to make it through all of my slides, so I'm going to give the talk again and record it so that anyone can see what I said with clear audio and see all of the slides. So the talk is basically all about what is Bitcoin SV, which is this seemingly brand new cryptocurrency with a bunch of subtleties around what it is. What just happened in the Bitcoin Cash split? This was the second split that Bitcoin Cash has been a part of since, the first one was its launch and the second one was this November. And finally, Money Button and how, Money Button, sort of fits into this whole story, which is my company, and I am the CEO of Money Button. So first of all, just a quick overview of what is Money Button. This here is a little movie of what Money Button looks like. So you can go configure a Money Button, go to moneybutton.com and make your own Money Button. The idea of Money Button is it is like the Facebook like button, but it's money. Now that we have internet money, we have basically really, really easy payments on the internet if only we had a good UI. So the idea for Money Button goes back to the start of my company, which was basically based on this idea of a social network that used Bitcoin micropayments. And we needed to make Money Button in order to make everything we were doing possible. So we started a project that would over time morph into what is now Money Button. Okay, so we can cover a little bit more of that later, but let me dive in and give you the background about how we got here, because it's an interesting story. So first of all, we started this project way back in 2015, actually. So it was late 2015 when we wanted to build a fully decentralized social network based on Bitcoin. And at the time, in 2015, altcoins were very, very small, and they seemed really silly, and it looked like it was going to be the case that Bitcoin was really the only cryptocurrency that mattered. And we wanted to build everything on Bitcoin. In fact, I don't even think we really took the idea of building on any altcoin or making our own altcoin seriously, because so many of them were basically scams. So we started building this product on Bitcoin, and we had a working prototype by early 2016. It was called DAT, D-A-T-T. It was hosted at dat.net, and we had a prototype, but the problem was that basically, it was a way for people to post content with integrated micropayments. You could monetize content with micropayments. We made basically Money Button in order to make it possible. The problem was that fees had gotten pretty high on Bitcoin at about 5 cents. Now, 5 cents in hindsight doesn't sound very high, but at the time that was really, really high because fees on Bitcoin had always been basically zero. So for them to increase to 5 cents was actually a disaster because we didn't know how big payments were going to be on this platform. We figured the average size would probably be about 5 cents, which would mean the fees would be 100%, which was outrageously high fees. So we started looking for alternatives, and basically we knew of the Lightning Network, and we researched Lightning Network, and we decided to implement our own routed payment channel technology. And over the course of the next year to a year and a half, we would research and develop basically what is a payment channel hub. It's like a form of the Lightning Network that is a little bit simpler, where the routing problem is solved because you always route through one central node. This is not quite as advanced as the Lightning Network, but it solved the problem we had, which was a way to do non-custodial payments while still preserving low fees. And we were able to lower fees a good deal this way. However, what would happen is over that year, from early 2016 to early 2017, basically the fees on Bitcoin would kept rising, and they got all the way up to about $5 in early 2017. And at $5, they're so expensive that, you do have to actually do on-chain transactions to open a payment channel. So it turns out that if you have to do something like 3 or so transactions to open a channel, you got to get money to your wallet from an exchange, transaction number 1. You have to fund the payment channel, transaction number 2. You have to have the payment channel itself. That's transaction number 3. There are fees that you have to pay for each one of those. And really, ultimately, you're going to have to close it. So the lower bound on the number of transactions per channel is about 3. And that means that's the cost of onboarding a user, which at $5 per transaction would be about $15. So $15 to onboard a user to a social network is a no-go. I mean, that is unworkable. Facebook earns about $15 per user per year. If it costs you $15 just to get them to use the app, it's unacceptable. I mean, there's no way to make the economics of that work. So we were in a crisis mode in early 2017, and we had to do something. So we actually ended up switching to Litecoin. Now, by early 2017, there were a good number of altcoins that were sort of available, that were big, and we could sort of pick which one we thought was best. We picked Litecoin because it's technically similar to Bitcoin, and all of our software worked on Litecoin with almost no changes. It took something like 1 day to fix everything to use Litecoin. So it was very easy to use Litecoin. That's the primary reason. It had lower fees, and it allowed us to continue using the same software, basically. So we were on Litecoin from early 2017 to mid-2017. But what then happened was, so we were finally able to launch like a fairly good version of our product that people actually used. We had actual users, and they were having fun using the app. The problem was that basically there were countless user experience problems with payment channels. For instance, you have to be online to receive a payment with payment channels, because the recipient actually has to respond to messages back and forth a few times to complete the payment. And that means we ended up measuring the success of payments on our platform. And because it's so rare that two people are online at the same time, that the success of payments on the platform ended up being about 50%, which is unacceptably low. I mean, that's extremely low. Like, you're telling me if I send money to someone, there's only a 50% probability, 50-50, that it actually makes it through. That's like really, really unreliable. So that's the biggest reason, but there are countless others. I now believe it is actually impossible to make Lightning Network user-friendly. You're never going to have a consumer payment network based on Lightning Network. You might have one based on-chain. So you might have one that uses on-chain transactions. And I'll get to that in a second. But in any case, I wrote an article on this. You can search for the article. I wrote an article about why we switched from Litecoin to Bitcoin Cash, because I'm giving it away, but we did switch to Bitcoin Cash. And you can see basically all the problems we had with payment channels and why we couldn't continue using them. We needed something that would actually function the way that people expect payments to function. So when Bitcoin Cash launched, we were extremely excited because Bitcoin Cash solved a really important problem. It had low-cost on-chain transactions. Now, at this point, we had spent about 1.5 years developing this routed payment channel technology. Almost all of our effort was on the payment channels rather than on the actual product. We were just trying to make it work. So that's a lot of effort. And when Bitcoin Cash launched, it solved such an important problem. Fees were so low, they're less than 1 cent for an on-chain transaction. We realized that our best option was actually to abandon the payment channel technology and use on-chain Bitcoin Cash transactions. So that's what we did. We ditched 1.5 years of effort, and we went on-chain Bitcoin Cash. So we archived more than 10,000 lines of code, very complicated code. I mean, this is stuff that's very subtle. So 10,000 lines may or may not sound like a lot, but there's a whole lot of effort went into that 10,000 lines to make that payment channel code that we just had to archive. And so Bitcoin Cash was great. We finally launched a good version of our product. We had users, we had growth. Everything seemed to be working well. And there was this giant sort of bubble in the cryptocurrency market, and our volume really tracked the bubble is what ended up happening. We grew a whole lot up until about January of 2017. And then, things basically started to get a lot harder, and we would ultimately end up deciding to build Money Button, because Money Button was a way to basically allow us more freedom to build more products and to let other people build products. So the idea of Money Button was to take this button that we had built in our product, which was at this point called yours.org, and make the payments functionality available to anyone for any reason. Including ourselves. So we could easily make new apps with Money Button and open it up for anybody to make apps. So that was great. So that lasted more than a year. That was a wonderful era. We did a lot of stuff in that era. We launched Money Button in this era. But then things started getting extreme in approximately August of 2018. So I have here two select tweets, one from Jihan, one from Craig. So Jihan is the co-CEO of Bitmain, and Craig Wright is the chief scientist of InChain. Now, my company, Yours Inc., that's the name of the corporation, we raised money from Bitmain and InChain last December, in December of 2017. We were all friends back then. We raised money very deliberately from both of these companies because it was strategic for everyone involved. We were all clearly allies in the world of big blocks. We all really believed in this idea of Bitcoin with big blocks because that solves the problem. That allows us to actually use it for business. And we were all on the same page, or at least it seemed like we were all on the same page, until things started getting really extreme. And so we raised $1 million from Bitmain and $500K from InChain. Okay? So those are the numbers. Bitmain is the largest investor. But things started getting really extreme, and basically people were disagreeing about what to do in Bitcoin Cash, disagreeing about what the protocol should be. And the disagreement kept getting more and more heated. And basically our investors, Bitmain and InChain, went to war with each other. I mean, they were actually, our two biggest investors were on polar opposite sides of this debate about what to do in Bitcoin Cash. And they went to war with each other. And our company is trapped in the middle. I believe we're the only company that raised money from Bitmain and InChain. And we were weirdly trapped in the middle. Now, investors aside, we were trapped in the middle anyway because it was really unclear what to do, whether we had raised money from these people or not. But having raised money from companies on each side just made things even more weird. And basically, the situation was there was nothing we could do to win. The only decision we could make would lose, and it was a matter of picking the least bad of the options, okay? And so we decided to go with Bitcoin SV. Now, that might not sound like much praise for Bitcoin SV. I do actually think Bitcoin SV is a great choice, but the reality of the situation is the split was very destructive. So the reality is we lost a lot of everything. I mean, we lost one employee resigned over the decision to go with Bitcoin SV. We lost money, of course, because the bear market has just killed our cryptocurrency holdings. We lost customers. People stopped using Money Button because they favored the other chain. We actually did gain some customers who chose us because we're on Bitcoin SV. But we really lost on net. We lost users. We lost friends. I mean, people that I was friends with are just gone. Some of them got really extreme, and we're just clearly not friends anymore. And some of them didn't get extreme. It's just that we're just in different camps, and friendships are just gone now. And a lot of people acted really extreme during the events and really ruined friendships. I hope I didn't do that, but I did act extreme, and I actually have an article you can read where I had to apologize for some of my actions during the hash battle because it was really extreme. I mean, it was emotionally extreme. I mean, it's really like a virtual war. It was as bad as I think that events on the internet could be. It was really computational war. It's really like Bitmain and InChain basically went to computational war with one another. Really like a sci-fi movie. I mean, they had their computers go to war with each other. I mean, instead of dropping bombs, they were dropping hash power. Okay, so anyway, we're on Bitcoin SV now, and what Bitcoin SV is just the original Bitcoin economic protocol set in stone, and we're going to scale it on chain. That's it. The reason why this is good is that basically I'm convinced this is going to work. I don't think we need to change the original protocol at all in order to do this. This is the best option, and although it's smaller in every way than the previous pre-split form of Bitcoin Cash, it is actually a very good choice. And on net, I think that long term this will either be better or it will fail. But if it fails, it's going to fail anyway. None of them are going to succeed. I think that Bitcoin SV has the strongest chance of any existing cryptocurrency to actually succeed at global adoption. So it's a great option. This is just Bitcoin, and I'll get to that in a minute. But let me compare the different forks of Bitcoin here, just so that you understand what the situation looks like from a company like mine, where we are just trying to build an application on Bitcoin. So Bitcoin Core has problems. Although they highly value keeping the consensus protocol the exact same, which is a perfectly fine value. I mean, there's something admirable about that, about never changing the consensus protocol. Pretty much never, not literally never. But they basically strongly resist ever changing the consensus protocol. This is built into the rules of Bitcoin Core. They're not allowed to change it. Bitcoin Core doesn't make decisions over the consensus protocol, which basically means the decision is to never change anything, is what their decision is. And I've seen enough comments from them. I think the only thing they would probably change would be basically if the cryptography is broken. I think they would hard fork under those situations. Or there might be others, but it would have to be something very extreme. They basically never hard fork ever. Now, what that means is that the fees have increased a lot since the early days. And not only have they increased, but they're wildly variable. They can change a lot, anywhere from a few cents to a few dollars at any moment, because it just depends on the weather. It depends on how many people are using it. So it's unstable. And also, there's no room to grow. I mean, as soon as you have one successful business on Bitcoin, because the blocks are basically full, as soon as you have one successful app, you would single-handedly raise the price of fees. So the economics don't work. And their roadmap is basically more of the same. Their roadmap is basically Lightning Network, and as I tried to explain earlier, that just isn't going to work. I mean, we have something like 15 user experience problems with Lightning Network that I believe can never be solved. Things like, not only does the user have to be online to receive a payment, you can't send a micropayment as a first payment. You have trouble routing. So with real Lightning Network, how do you route? How do you explain weird payment channel states? How do you explain payment channel failures? How do you explain the fact that you have to wait before you can onboard, that you have to, even just opening a payment channel takes hours? All of these things are really bad user experience problems. So the economics and the roadmap are unworkable for what we're doing. I mean, we just can't use Bitcoin Core. And when people say, why don't you use BTC? Come back to BTC. It's just not going to happen. I mean, it doesn't work. It doesn't solve the problem that we need to solve, which is we simply need people to be able to send money to each other over the internet without paying ridiculous fees. That's it. We need the idea of internet money. We need the original idea of Bitcoin. Okay, so Bitcoin Cash. Now, I don't mean to be mean to Bitcoin Cash when I say these things. I'm just saying this, for their sake, if they listen to this, they being basically the people on that side, the ABC people. This is just how it looks. The reality of what Bitcoin Cash is, first of all, protocol experimentation. This is fine if you want to change up the protocol all the time. Like, as an idea in the world, if you want to do that, do whatever you want. But from a business perspective, this is really problematic, because the reality of the way that Bitcoin Cash operated from launch until now is that Amari can just decide to do things and everybody else follows. This is extremely dangerous. I mean, Amari is not perfect and has made several mistakes throughout the past year and a half. One of them was Cash Adder. Fortunately, we've been able to reverse Cash Adder in Bitcoin SV. It was a mistake because Amari had his reasons for liking Cash Adder, and whoever else was involved in that decision. And the problem was they just ignored the business reality that if everybody has to write a completely different type of address format, it's not going to be universally adopted. And that's exactly what happened. Many of the wallets and exchanges simply never adopted Cash Adder. So instead of having a better address format, we now have a world of mixed address formats. That's just one example. But also, obviously, the split. I mean, if Amari is willing to split over these basically irrelevant technical changes. I mean, I've criticized DSV. I haven't been too critical of CTOR or CleanStack, but the reality is the benefits of any of these things are extremely unclear, I mean, at best. And he's willing to just play a game of chicken with the miners and fork over, these ridiculous things that really don't matter. Why did you guys split the currency over these things? You didn't need to push for CTOR and CDS, DSV, and CleanStack. These things are irrelevant. I mean, this is ridiculous. So, I mean, experimentation is very dangerous from that perspective, that I'm just not convinced this is going to work. I don't know what you're going to do. Now I believe you have an unclear roadmap. Now I know that there's a published roadmap for ABC. I mean this in the sense of just experience. It doesn't matter if you publish a roadmap now, because your reputation in Bitcoin Cash is one of unreliability. It is one of things are going to be changed up at any moment for any reason, for reasons that are in Amari's hands. So the checkpoints are the great example of this, of course, and I don't mean to harp on this endlessly, but the reality of what happened on the day of the hash battle was insane. I mean, the fact that the Bitcoin ABC people colluded with exchanges to update the software secretly, and not only did other development groups not agree, they weren't even consulted with. I mean, no one even knew this was happening until post facto. So that's the reality of the way Bitcoin Cash operates, is that they can just change the code at any time behind your back. And this is unacceptable from a business perspective, especially considering every single time I've tried to give some type of criticism to Bitcoin Cash, I've been dismissed. That none of my criticism has been adopted. And the two particular pieces of criticism I'm talking about in particular are Cash Adder and DSV. In both of these cases, I was critical, and I was just ignored. My criticism was ignored, and I wasn't wrong. I was right about both of them. So Bitcoin SV is the best of all of these, because stable economics and a workable roadmap. The economics are just the same. They stay the same now and forever. We can build on that. The roadmap is workable because we're just going to scale on-chain as quickly as possible. This is exactly what we need. That's it. We don't need to be changing up the protocol over and over and over again. Okay, so now I want to go into, I'm going to discuss several different concepts that are related to the split and related to things that I've learned that other people seem to not understand or not agree with. And so I'm going to cover all of these concepts, mostly for anybody that's new that wants to understand things. I'm going to cover all these things. So first of all, why do I say things like Bitcoin SV is Bitcoin? I recently wrote an article on this. And I think the way to think about this is, what's the difference between a consensus protocol and an economic protocol? A consensus protocol is what Bitcoin Core keeps fixed. They never change the consensus protocol. The implication of that is that the economics vary wildly. So by fixing the consensus protocol, the consequence is that you have unstable and unworkable economics. If you keep the economic protocol fixed, that would mean things like keeping fees, if not fixed, then predictable. It's actually okay if they're not strictly fixed. They could vary, but they need to vary in a way that is predictable, that basically that you can build on in a reliable way, so that if you know what the fees are going to be, you can work around that. And of course, it's better if they're simply fixed, and it's better if they're always decreasing, always getting cheaper. But that would be what a fixed economic protocol is. Or to put it differently, imagine you build an app on Bitcoin. So long as you build your own app in a scalable way, the app needs to not break over time due to protocol changes. That's it. That's what economic protocol stability means. Bitcoin SV has that. This is a value of Bitcoin SV. Bitcoin Core doesn't have that. Bitcoin Core's answer is everybody has to rewrite everything. I mean, that's what Lightning Network is. It's every app that you made in the past is now irrelevant. It needs to be rewritten from scratch to do everything in a completely different way. That is incredibly unstable economically. So the difference between Bitcoin Core and Bitcoin SV is that Bitcoin SV has a stable economic protocol and a changing consensus protocol. It's necessary to raise the maximum block size and eliminate all these other limits, which does change the consensus protocol, in order to keep the economic protocol fixed. And Bitcoin Core is the exact opposite. Bitcoin SV is on the right side of this. The right decision, the right way to grow, the right way to get adoption is to keep the economic protocol fixed and to change the consensus protocol exactly as needed in order to keep the economic protocol fixed. So Bitcoin SV is correct and Bitcoin Core is wrong on this point. Now, if you go back in and read the stuff that Satoshi wrote originally, Bitcoin SV is the idea of Bitcoin. This is the version of Bitcoin that Satoshi wrote about in the white paper, that Satoshi wrote about on the forum, and the mailing lists and the emails, and that is discussed in the comments in the original source code. This is it. Okay? So that's what I'm talking about. I'm talking about the original economic protocol. That's what Bitcoin SV is. I'm not talking about the original consensus protocol. The original consensus protocol it's like a red herring. It's like a completely irrelevant thing, okay? So that's what I mean when I say Bitcoin SV is Bitcoin. Okay, so I want to talk about another concept now, this idea of Bitcoin at scale. And another way to think about Bitcoin isn't how Satoshi defined it. It's what it will be when it is actually adopted globally. And when it's adopted globally, I'm talking about the idea of really big blocks. Gigabytes soon, terabytes eventually, and long-term exabytes and even larger. So we can go very, 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 very large because basically we're nowhere near any physical limits. I mean, the way to do this at ludicrously large scale is simply, blanket the planet in meter-thick optical fibers that send around ludicrously large blocks at light speed around the world, and have computers with, trillions of ASICs that do nothing other than run scripts, okay? I mean, in parallel. I mean, you can parallelize and scale Bitcoin all the way up to ridiculously large sizes, and we're nowhere near any limits at all. It will take more advanced technology, but the incentives are there to do it. The incentives were correctly designed from the beginning. Miners will develop the technology as needed as the network grows. We've seen this happen in practice. It used to be theory, but we know it's reality now. We can see miners going through a really, really fast-paced R&D cycle to improve mining hardware continuously. It will happen. Or rather, I should say, if the project is successful, at scale, we're going to have ludicrously large blocks, ludicrously large transaction volumes. Not only is everyone in the world going to be using this, they're going to be using it for a lot more stuff than they currently use money for. So you're going to do things like when you play a video game, every single action in the video game is an on-chain transaction. I mean, that's the scale we're talking about, where you do a transaction every single second of your life. That's the scale we're talking about. That is what Bitcoin at scale is. And Bitcoin at scale has certain properties. It is virtually impossible to change the rules at scale, for instance, because it would be so disruptive to the entire world economy, it couldn't get done. If anybody tried to do that, the entire world would be opposed to anybody trying to change anything about the protocol because it would break the entire world economy. So the protocol would be incredibly, incredibly secure. It would not change. The only thing that would change would be something that affected everyone equally, something like broken cryptography. Broken cryptography would be a giant opportunity for cryptographers and computer scientists to solve when it's at scale, because you would become world famous for solving the cryptography problem of Bitcoin if the cryptography were broken. So it has properties like that. That's what Bitcoin at scale is. Of course, this vision for Bitcoin at scale is completely unrelated to Bitcoin Core. Their vision has nothing to do with this. They don't even have a vision for Bitcoin at scale because they don't know how to get more than 10 million daily active users, even with Lightning Network. They have no idea how to get anywhere near global adoption, much less beyond. So that's the idea for Bitcoin at scale. And I'll just quickly reference, because it's related, Craig Wright's idea of MetaNet is the sort of the most thorough and deepest manifestation of this idea of basically Bitcoin as everything. It is the foundation of everything in the economy and the foundation of basically everything that you do that involves anything economic. So interacting with other people is economic. I mean, basically everything that you do will be on-chain in the future in this vision. Okay. Another idea I want to talk about is that privacy improves at scale. A lot of things improve at scale, but I want to talk about privacy specifically because it's a crystal clear example of something where you can see how everything actually gets better as the network grows. If you try to use CoinJoin right now, you want to buy an item for some amount of money, and you want to do CoinJoin, which is where you build a transaction with a bunch of other people. In order to actually have privacy, you have to send the same amount of money as the other people. And so when you go to buy something, what's the probability that anybody else out there is using Bitcoin to try to buy something that's the same cost that you're buying at the same moment so that you can do CoinJoin with them? The answer is basically zero. I mean, there probably isn't anyone out there because Bitcoin isn't big enough yet for that to be possible. But as Bitcoin grows, more people use it as money. More people are sending transactions. The probability that there's somebody else out there that wants to send the same amount of money as you increases. And at scale, it becomes almost a certainty. So if you go to Starbucks to buy a latte, what is the probability when Bitcoin is at scale that someone wants to buy the same latte as you at the same time? It's actually very high. Starbucks have tons of customers. I've been even within one store. It can be someone wants to buy the same latte as me at the same time for the same price. Much less the thousands or however many hundreds of thousands of stores they have around the world. There's a very good chance that there's actually a lot of people that want to spend the exact same amount of money. And so you can actually do CoinJoin with every single transaction at scale. So this makes it much more private. You can also do merge avoidance. Merge avoidance is a different idea of never merging your UTXOs. So these privacy technologies, so long as transactions are cheap and it's widely adopted, privacy becomes really good. The other thing that improves is the idea that at scale, blocks are so big that it's expensive to have the blockchain. It's extremely expensive, and it's extremely expensive to analyze the blockchain because there's such a giant volume of transaction. Just sorting through them and piecing together a graph of everything is a giant challenge. Even the government, the US government, or any of them, will have a challenge doing this at scale. I mean, when blocks are actually exabyte, even the NSA is going to have problems graphing and charting and understanding everything. They will probably have a copy of it, but they're not actually going to have a record of who everyone is because it's too difficult to do the data. And I mean, you just won't know. I mean, when somebody creates a transaction that goes to an address, there's no way you know who that is unless you have other sources of information off-chain. So at scale, privacy is extremely, extremely high. Even from nation states, okay? In fact, it's actually better. It's actually much better because the NSA has no problem at all, analyzing Bitcoin Core in nearly complete detail because it's a relatively trivial data analysis problem compared to what it would be at scale. Okay. Another concept I want to talk about is the idea that every problem with Bitcoin can be solved with Bitcoin. This is a really important idea that's related to the Bitcoin Cash fork. You don't need to keep mucking around with the basic protocol. Quit changing the protocol. The protocol, Bitcoin, was solved on day one. Version 0.1, launch day, the protocol was correct. The protocol goes all the way to global adoption. It brings sound money to everyone in the world. Peer-to-peer electronic cash for everybody in the world. There's nothing else you need to do. Now, that's not to say that there are no problems whatsoever, but there's nothing you need to do with the protocol other than scale it. It's like the internet. Like once you have the protocol, like making these minor tweaks do not actually create value. They destroy value. When you muck around with it, you're just making it harder for businesses to actually survive on top of this thing and grow and solve things correctly, which is with business. So the idea of every problem with Bitcoin can be solved with Bitcoin is, do you see a problem? Then solve the problem by starting a business. And what you do is you earn Bitcoin, save Bitcoin, spend Bitcoin. That's it. You can solve every problem this way, and I'm going to give you a couple of examples. So first of all, ZeroConf. Everybody's so worried about how, we don't have instant transactions because there's a security vulnerability. But you can actually solve this with business. You don't have to change the protocol. What you can do is, first of all, imagine you aren't starting a business. How would you actually solve this? Basically, what you need to do is you need to put a probability on a transaction that it's fraudulent. If someone gives you a transaction, you want to know whether to accept it or not. And so you need to know what is the probability of fraud. And if the probability is too high, you don't accept it. And a way you can do that is to basically, you can do this in countless ways. You can have all sorts of information. You could have a reputation system, which is the type of thing we are very likely to do on MoneyButton. We'll have off-chain abilities to compute the probability of a double spend. So we'll do things like, are you a new user? Then your probability of double spend is higher. Are you someone that's been around for a year and you've never double spent? Then your probability of double spend is low. So we can do things like that, and that's off-chain, right? That's a reputation system off-chain. It can be on-chain too, but it doesn't have to be. You can do other things like if someone gives you a transaction, one of the ideas we have for Money Button is we will create another node on the other side of the planet, because one of the ways that people double spend is to broadcast two different transactions in different places. And so by having another node on the other side of the planet, it can be really hard for someone to create a transaction that we don't see, that we're very likely to see most transactions that way. And so if someone attempts to double spend, we're likely to see it. The other thing to do is to connect directly to miners and to ping them. And so we ask the miners directly, do you think this is a valid transaction? And this can be done without protocol changes. That is very similar, actually, to the idea of avalanche and pre-consensus. It's just that it doesn't require protocol changes, and it doesn't have to be built into the node software. This can be done by just writing additional software and having new protocols on top. So that's how you do zero-conf. You can do scaling, too, and as well as every other problem, but I'll run through scaling real quick. The end game for mining, mining is actually a way of computing hashes over and over again. Miners are experts at hashing, not at transaction validation. Transaction validation is something very different, and at scale, transaction validation is going to be a specialized task. There will be different entities that do transaction validation. So there you go. That's a brand new business that doesn't really exist. Mining pools kind of do it, but mining pools will actually probably want to offload this, because mining pools are actually experts at operating the pool. Miners are experts at operating hash power. Validators are going to be the ones that are experts at validating. That doesn't exist yet, but it will exist. So consider that a prediction about what will happen at scale. There's going to be new entities that their role is to validate transactions in exchange for money. They will be paid with Bitcoin to validate transactions. And you can also use smart contracts in some cases to actually do things like limit the ability of committing fraud in circumstances. So that is how I see that happening at scale. And this is the way you want to think about it. Whenever you identify a problem, quit assuming that you have to change the protocol. How can you solve this problem by starting a profitable business? That's the right way to think about it. And if everyone solves problems in Bitcoin that way, we're going to go to global adoption very, very, very quickly. This is the right way to solve every problem. Quit changing the protocol, just scale it, and solve problems by starting businesses. Everyone will win this way. Everyone in the world. Okay, the next idea is that Bitcoin is a peer-to-peer electronic cash system. Peer-to-peer electronic cash is the title of the white paper, misunderstood by almost everyone. I want to give another sort of shout out to Craig Wright, who did an interview recently where he just kept saying this, and it just made me think about the implications of it. And I thought of some new ideas as a consequence of hearing Craig just emphasize this over and over and over again. So what this means is that the sense in which Bitcoin is peer-to-peer is absolutely not that everyone runs a mining node. That was never the idea. It is a peer-to-peer electronic cash system. That means if Alice gives Bob money, Alice gives a transaction to Bob. That's what it means. You literally give the transaction to the other party. There is no trusted third party when you give a transaction to someone peer-to-peer. If they trust you, okay, if the two parties are mutually trusted, there is no trusted third party. It is purely peer-to-peer. It is purely private. It is an ideal system, okay? That is what peer-to-peer electronic cash means. And you can solve all the problems in a different way when you look at it that way. This is not about having users run a validating node. You do not need to do that. Wallets exist on a spectrum between offline and full nodes. And almost all wallets are somewhere in the middle there. There's some level of validation that you want to do for your use case, all the way down to no validation. Because if you are in a purely trusted situation, you don't actually need to validate anything. You can transact over and over again by trading transactions off-chain in a trusted way, and you don't even put them on-chain until you agree to settle. So if things are trusted, it's actually really easy, and you don't change the protocol at all. You can think of it as being a radically simpler version of Lightning Network, where, instead of this convoluted smart contract system they developed, you just pass transactions around. And when you do that, it's instant. You have highly desirable properties like, it's free, basically. You just give a transaction to somebody. It's free. It's zero cost. And it's instant. It's literally as fast as you can give them a message. I mean, it's like you don't get better than that. So that's what Bitcoin really is. The miners are a time-stamping service. That's what they do. The miners do not actually process transactions. What they do is they timestamp them. They say this transaction was created at this time or earlier. That's what they do. And they never mine conflicting transactions. That's all they do. They're a time-stamping service, and that's it. So there is no like money transmitter or something like that in Bitcoin. It is a purely peer-to-peer electronic cash system. So again, this is something that we're probably going to have to keep saying. Craig is probably going to keep saying it because it's necessary, because no one understands it. No one understands the basics. There literally isn't even a wallet that actually acts this way. In fact, when Craig started emphasizing this stuff recently, I realized, gosh, even our wallet doesn't actually act this way. And it made me rethink the way our wallet infrastructure worked and how we can actually improve things as we scale. So anyway, I hope that idea is clear. That's actually related to another idea I want to mention. I don't want to go into this in detail. This could have its own entire video, but I just want to talk about how well-designed Bitcoin is. That really, when I say things like Bitcoin was a solved problem on day one, I really mean it. It solved the problem of money for the world, not even just for planet Earth, but actually you can take Bitcoin into space. Now, this might sound a little unusual, but I think that if you are actually trying to create world money, you do need to actually think about the future and be aware that humans might go to space. And it turns out that, and I don't know if Satoshi conceived of this when he was creating Bitcoin, but you can actually take Bitcoin to space. That it actually is so well designed that it actually does function perfectly in space, with some interesting caveats. So let's just think about the implications of this. First of all, when you understand that it's peer-to-peer electronic cash, you can take your UTXOs into space with you. Now, the problem with space is that you basically are very far away from Earth. So if you travel to Mars, you are anywhere from something like 3 minutes to 30 minutes away. Or that is to say, like the message distance is away. So on average, you're actually further away. That is to say, it takes longer to send a message back to Earth than the block interval. And what that means is that you basically can't have miners on Mars. Because if you were a miner on Mars, you would basically never ever succeed in like getting an actual block on the blockchain. I mean, you need to locate your miners on the planet Earth so that you can broadcast your blocks to the other miners and have them actually mine on it. You won't be able to do that from Mars. But what you can do is you can do the notion of peer-to-peer electronic cash on Mars. You can, in a fully trusted way, if both counterparties trust one another, you can transact with Bitcoin transactions on Mars. And then what you do is you basically settle back on Earth. And you can go further than this. So because you might be irritated with this idea of having to settle on Earth, say once a day or however often you decide to do it, you can actually make another blockchain on Mars. Because what you could do is you realize, okay, so you're telling me that the SHA-256 miners are worthless on Mars because there's no way you can mine real Bitcoin blocks on Mars. What you can do instead is you could actually mine a different chain. And I don't actually mean this in the same way that most people mean. I'm not talking about an altcoin. I'm not even really talking about a side chain, although arguably this would be a different kind of side chain. What you do is you literally create a new Genesis block where you start with somebody's transaction that is just a normal Bitcoin transaction, and you start building a double SHA-256 proof-of-work blockchain on top of that on Mars with mining hardware. Because the only thing you can do with SHA-256 mining hardware on Mars is mine a totally different chain. So you may as well mine a different chain on Mars. But the difference is there are no new Bitcoins being created in this chain. This chain consists only of transactions based on the Genesis transaction. Okay, or maybe you can bring in other transactions, and maybe you can exit somehow by, going back or something. So I'm not sure how this would work in detail. You'd have to work it out. But the idea is simply to have a new blockchain, and you can pay those miners with outputs. You literally pay them in the outputs of your transaction. So, for instance, one way to do that would be imagine there are 7 miners, and they have, A, B, C, D, etc. hash power. Then what you do is you create a transaction with 7 outputs that gives however much you want to pay in fees divided proportionately, A, B, C, D, etc., in terms of how much you pay them in the transaction output. So you can pay the miners on a completely different Mars chain that actually is Bitcoin. I mean, it is actually valid Bitcoin transactions that are actually on the main chain and do get settled to the main chain repeatedly. But while you're on Mars, you can now trust those miners to basically, sort of with high probability settle that chain back to Earth. So on Mars, you would have like a different blockchain that you could trust in exactly the same way that you trust Bitcoin on Earth. And it is Bitcoin. I mean, it is the exact same thing. It's the same money. It would be like taking gold from Earth to Mars. And it would be like if you want to validate gold, you're still going to have to validate it, just like you can transact gold peer to peer too, right? And if you trust people, then there's no problem. I've bought and sold gold, and I go to the store and I buy and sell, and I trust them. And the only non-trusted part of it was like they would weigh it to make sure it was the correct weight, okay? Because it wasn't a huge amount of gold. But if you don't trust people, you do validators, and that's basically you can have that. But you can opt into this validation in various ways. So you've got multiple different ways you can validate. I'm not even sharing all the details, but if you think about how a wallet would work, there really is a giant spectrum of amount of validation that you can do depending on how much trust you have in the other person. And ultimately going back to, like, if you don't trust anybody about anything, you got to go back to Earth and look at the real blockchain, basically. Okay, so that's the idea of Bitcoin in space. That's how well-designed Bitcoin is, that starting on day one, the protocol was already sufficient to expand throughout the galaxy. That you can take this out into space and grow. The entire world economy expands outward into the entire galaxy and takes Bitcoin with them the entire way. And this idea, of course, only makes sense with Bitcoin at scale. You try and work how you would do this with Lightning Network, it is impossible. Okay, you're not going to do this with Lightning. You can't even do it with most other blockchains because they don't understand the idea of peer-to-peer electronic cash. If you have to be in touch with everybody else in the world to do it, then you can't do it in space because the speed of light limits you. When you are offline, which is how it has to be in space, then Bitcoin is amazing. It's like you realize, oh gosh, it actually was completely solved on day one, and all these other things that people are doing are actually literally regressions. They're actually making it worse because they create requirements to be online, which makes no sense in space or in any other offline context. Okay. Another concept I want to talk about is that not every problem has to be solved exclusively with cryptography. There's some kind of myth in the crypto world where people are heavily anarchist and they always avoid dealing with the law in any way. And I think this is a poor way of thinking about it. Even if you are an anarchist, A, law exists, B, law is actually useful. Also, no matter how much you hate the government, I think the law is really a different idea. It'd be a really bad thing if we lost the notion of private property, because you do actually have to have protections for private property. However it is that happens, that is law. That's what we're talking about. We're talking about the idea that if someone steals your Bitcoin, you have recourse, okay? So that if something goes wrong with these protections, just like you might have a lock on your house, the lock is not perfect. The lock is a deterrent. It makes it hard for people to break into your house, but it doesn't make it impossible. Cryptography is exactly the same way. Now, when somebody breaks into your house, you use the law, okay? You do what you can. You contact the police or whatever. You sue somebody, who knows, however it is. But you use the law as a sort of final recourse. And you can and should do the exact same thing with Bitcoin. You can trust people. If you have a reason to trust people, you trust them. And if they break that trust by committing fraud, then you have legal recourse. Not every problem has to be cryptographic. Okay, not every problem has to be solved with cryptography. And I don't know if I have any specific examples other than to just, you have to look at everything holistically. There are several different aspects to the world that you need to understand to see how do we actually make something that will actually work as world money. And you need to be legal, and you also should just realize literally sometimes the best way to solve something is actually the law. So this is what allows us to have trust. Because if if your trust is violated, your recourse is the law. Okay, not necessarily crypto. It can be crypto, and I'm not saying don't solve problems that way. I'm just saying, by all means, use the law. It exists. So, if somebody commits fraud against you, use the law to defend yourself. Okay, miners get paid with transaction fees at scale. This is an idea that this seemed obvious in the early days, but it's like, the way that people talk about this now is so different. So everyone realizes that the fee subsidy is going to zero over time, that it halves every 4 years. And so the miners have to get paid with transaction fees. However, the idea of the Bitcoin Core has that the way it's going to work is that people are going to pay very, very high fees, I think is wrong. I mean, I think it's simply wrong. It's plainly wrong. No, people aren't going to pay high fees because there are going to be competitors that are equally, if not more, secure with low fees. No one is going to be opting in to paying high fees. The only way this works is if the fees are very, very low. And the only way that works with the ever-declining fee subsidy is if the amount of transactions is ludicrously high. So we have to get very, very, very high transaction volume. This is why Bitcoin at scale works. Like, everything fits together correctly in an ideal way at scale. Bitcoin itself, it's like a child with high potential who has to go through school and become an athlete or whatever to actually achieve their potential in life. This is Bitcoin. Bitcoin has to grow up. And whatever Bitcoin is right now, it is like a little baby. And the way we get all the way to complete maturity, where all of the benefits of Bitcoin are finally being really appreciated, is with incredibly low transaction fees and a ludicrously large number of transactions, so that miners still earn a lot of money. So that's just how it's designed to work, and I think that's the only way it's going to work. It's either going to work that way or it's not going to work. The idea that Bitcoin Core has that people are going to pay high fees, I think, is just faulty. It simply isn't going to work, and at best, that is a niche product. Okay, and the final idea that I want to talk about is I believe the incentives of Bitcoin are designed to eliminate all of the competition. That there's only going to be one proof-of-work blockchain to rule them all. The idea is that basically blockchains that share the same proof-of-work are not secure. It is an unstable situation. You're always at risk of being destroyed by the bigger miners on the bigger chain. And the only way this is working right now between BTC and the two other ones is basically that, there are a lot of reasons, but, people aren't really using this stuff as money. If they were using it as money, one of the smaller ones, BCH or BSV, would vastly outgrow BTC. And BTC would be at huge risk in that situation because there is no reason for it to exist anymore. So anybody can earn money by just wiping it out. It's inevitable. There's no way that's going to work anymore. We all recognize that the real Bitcoin is one of the other ones. And the old Bitcoin, BTC, is just completely screwed because it's no longer the longest work by total proof of work. No one would even really like it anymore. It would be so obviously doomed that the market price would plummet. And miners would either reorg it or the price would just crash so much that they don't even want to bother to reorg it. So that's the idea of what will happen at scale. I believe this applies not only within one proof of work function, but also across proof of work functions. And it's instructive to consider in the early days of Bitcoin, we actually predicted the existence of GPUs. I wasn't around before the GPU era, but people did predict that they would exist. People then predicted that FPGAs would be adopted next, and then ASICs would be adopted after that. And exactly those things happened, because when you understand the incentives, the miners are actually incentivized to do research to improve their mining hardware, to be better at mining, so that they earn more money. And they actually are incentivized to improve their hardware. And the next natural step is actually to develop custom hardware that is actually designed to be flexible in a similar way as an FPGA, but where you can mine across proof-of-work functions. So that the same hardware, the same way that you can burn in something into an FPGA to give it a different layout, and then have do something different on it. You could do that with proof-of-work mining hardware. No, this mining hardware doesn't exist, and I couldn't give you complete detail about how to build it. But I believe that it is possible, and it's a type of thing the incentives encourage. Because if you can buy one piece of hardware that can mine every proof-of-work blockchain, obviously that's better than one that can't mine, that can only mine one of them. Because then you have the flexibility to switch between them. When that happens, every single proof-of-work blockchain is at risk. I mean, it is now the case that it is a highly competitive landscape across all proof-of-work blockchains. No one is safe. Whichever one is the biggest is going to be way, way, way bigger. And the other ones will be driven down either by being destroyed or by people anticipating that they will be destroyed and the prices will plummet, and so no one will bother to destroy them. So the incentives all align to ultimately have one proof-of-work blockchain in the end. And I believe right now the best chance for that is Bitcoin SV. And I think that everything else basically just has a lower probability of succeeding. So that's all I have to say. That's my presentation. I hope that was interesting and informative to you. And there will also be a version of this available that was recording, but the quality will probably be low. And in the recorded version from last night, I didn't go through all these slides. So you got to see the full version of it this time. So that's all I have to say. So thank you very much for watching this presentation. And please check out Moneybutton at moneybutton.com. Thank you.